Hello, this is Julius from Basic Financials. I'm sorry I haven't done a video for a while, but at least we're back now. Now, today I'm going to talk a little bit about payments on account of tax for self-assessment. Now, this applies not just to the self-employed, although it's normally for the self-employed, but given the fact that people are likely to be getting more interest on savings now, that might have taken them into the tax bracket and the requirement to then do tax returns. If your interest received is more than £1,000 a year and you're a basic rate taxpayer, then you have to pay tax on that interest. If you're a higher rate taxpayer, where your income's over about 50,000 in total, then you have a £500 savings allowance, so you would have to pay tax on any interest over £500. There is another level, but I won't talk about it at the moment. It's when you get into additional rate tax, and that's when your income's over 120,000. But so that's why you might need to do a tax return where you didn't before, and why you might end up having amounts to pay, and which would potentially result in payments on account. Now, as I say, this is normally for the self-employed, because what happens with the self-employed, they've not got any income which is taxed at source, or they might have, but let's say you're just self-employed, then you've basically got your income from profits, and that isn't taxed until you do your tax return and you declare your profits, and then it's all worked out then on the tax return. So what happens then is HMRC will want you to try and pay some money in the January, on the 31st of January before the end of the tax year, and the 31st of January after the end of the tax year, the end of the tax year being the 5th of April. So if, let's say, you were sort of going along steadily year on year, making profits of say £50,000, and let's say that your tax bill, let's say for example it is £10,000 to make the figures easy. Now you would be paying, so your tax bill is £10,000 a year. Ideally you would be paying £5,000 on the 31st of January, £5,000 on the 31st of July. So for example, the year ended 5th of April 2024, which we're about to come up to. You will have paid £5,000 in 31st of January 24, and then you'll pay another £5,000 31st of July 24, and that would put you straight for the whole year. And then same thing next year. Now that all assumes that profits are all going steadily, not rising or falling. Now obviously that isn't always the case. You might have quite a good year, you might have a bad year. Now one thing and also you might be on your first year, so you might have just started out. Now let's take an example where you have a not such a good year, or maybe you've made an investment like in a van, and you've claimed capital allowances which reduce your profit significantly. So maybe your profits were £50,000, but you actually spent £50,000 on a new van, or maybe let's say £40,000 on a new van, leaving 10,000 profits which are covered by your personal allowance, so you wouldn't have a tax bill. So say for the year to the 5th of April 24, you have that's happened, so you've got no tax bill. So you've made payments on account of £10,000, £5,000 in January and £5,000 in July. You've done your tax return, let's say in August, because you haven't waited until the last minute, and you'll get a refund because you weren't due to pay any tax. Great, brilliant. But that does mean, because they base the payments on account on the previous year's profit, so they will assume that your profit's going to be, or no tax again, so you won't make any payments on account in January 25 and July 25. So that's great, yep, seems great, but you do your accounts for the year ended 5th of April 25 and you find you've got a £50,000 profit again. So you've got a £10,000 tax bill again, but you've paid nothing on account in January and July. So in January 26, which is when you have to pay a balancing payment if you haven't paid enough on account, you'd have to pay the £10,000. But not only that, they would base your payments on account based on that previous year. So you'd split the payments on account into two. So you would have another £5,000 to pay on the 31st of January 26, and then you'd have £5,000 to pay in 31st of July 2026. So that means that 31st of January 26, you've got £15,000 to pay, which is a bit of a shock because you've not paid anything. I mean, it shouldn't be a shock, not if you listen to this video anyway. But it can be if you don't know what's going on and you're not keeping track of what's happening with your payments on account. Now, it could be that, as I say, if you've got interest received, I mean, you could imagine, say you've got built up savings over your life, and you've got say £200,000 in national savings and investments. At 5% interest, that would be £10,000 a year interest. So all of a sudden you've got if you're say you're a higher rate taxpayer, which would be great if you're a pensioner, for example, and you're still getting that amount of interest, but you'd have £4,000 tax to pay on £10,000 interest. Now that would take you into self-assessment and payments on account, so it can happen that you'll be caught with that as well. I'm going to leave it at that because it's probably enough to take in. If you've got any questions, please just ask them in the box below and leave any comments and like if you can. And I'll see you again. Oh, and remember to subscribe as well. But I'll see you again for another video. Let's hope a little bit sooner than last time.